Good morning and welcome to the European Assets Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives in the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Christine Cantrell, Head of Investment Trust Sales. Good morning.
Thanks very much, and we're delighted to be here. Sam Kosh and Lucy Mars have been running European Assets Trust together for the last 10 years or more, so they are thrilled to be able to update you on the portfolio and answer your questions. So please do start submitting them as we go through the presentation. I just wanted to remind everyone, European Assets Trust is managed now by Columbia Threadneedle Investments, as it was part of the deal being acquired by acquiring BMO Global Asset Management. But yeah, please enter any questions and we'll answer them towards the end of the presentation. Thanks very much.
Good morning all. My name is Sam Kosh. I'm the lead manager of European Assets Trust. Today Lucy and I will go through a presentation. I will start by giving a brief background to European Assets Trust, recent performance, and also talk about the challenging market environment that we're operating in. And I think that the conclusion really is that we have to take advantage of these volatile markets when we can, because they tend to produce good long-term returns. But just to kick off on European Assets Trust. So European Assets Trust is an investment trust. It's a conviction portfolio of high quality, niche, small cap growth companies that happen to be listed in Europe. Many of these are global leaders, in fact. We like quality growth businesses, but we're not prepared to pay anything for them. We do believe that valuation is an important component of returns. The trust pays out 6% of the year-end NAV to shareholders, and this is distributed quarterly. This dividend payment is a combination of both capital and income. We're very heavily research-based investment house, and that our research capabilities have only increased with the now sitting under CTI Investments, and we focus on competitive advantages or moats. The reason for that is that the moats help businesses, are the principal reasons why companies can protect their profits from competitors, and we think long-term profit generation is the key reason for companies outperforming over long term. We're benchmark agnostic, happy to be contrarian, and we really look to buy the best business models, irrespective of what sector they're in. We are celebrating our 50th year this year, and what a year to do it. We're looking at the screens daily, and there's a lot of red on the screens, but it helps really to have a long-term context to that very challenging market performance. Over the 50 years, we've seen war in Balkans, so war on Europe's doorstep. We've seen oil price shocks. We've seen a global financial crisis. We've seen a sovereign debt crisis within Europe, and we've seen COVID. So today's problems really should be put in that context. And when we presented this slide at our AGM in May, we could say at that point that 1,000 euros invested in 1972 was worth over 31,000 now. Now, that's not quite the same today, given what's happened with markets. But I think that sets the context that if you have a long-term view, you can take advantage of market crises to put capital to work and deliver long-term returns. So performance, while we've had a strong 2020 and a strong 2021, clearly this year's been very challenging for the trust. The market environment has been very difficult, obviously. We were sitting here this time last year talking about a post-COVID recovery, but this has clearly been swamped by macroeconomic and political issues. We've had rising inflation expectations driving a much earlier than expected tightening cycle and rising bond yields. And we've seen massive rotation away from growth quality stocks to the benefits of value sectors. And really, that's the principal reason for our underperformance. Actually, if you look at the operational delivery of the companies that we hold, they've in aggregate been good. So we've just suffered from very aggressive multiple compression. We're also clearly seeing rising costs from energy to staff, logistics, materials, and this is a real challenge for economic growth and corporate earnings. And we're now seeing that the negative economic impact beginning to show with earnings downgrades across the market. So very challenging environment to invest and a very challenging environment for a growth investor, particularly with this rotation. And the next slide helps to articulate this rotation well. In normal market falls, you tend to have the more defensive sectors outperforming, but this year has been very different. Healthcare, equipment, an area of stability, earning stability, has been very severely impacted. So has software, which again tends to be quite a defensive area. While what you've seen outperform is energy for obvious reasons, but also banks, for example, and insurers. And so we've had a real dispersion in the market, and not the dispersion you would expect in a very weak market conditions. And despite our very challenging year-to-date performance, the performance of the portfolio since we've been managing it is still above the benchmark in both NAV terms and share price terms. So the investment backdrop. Well, we're reading negative news every day. Of course we are. Europe regionally faces the most significant negative impact from the Ukrainian war, a war on your doorstep, impacting energy supply. It is clearly going to impact the region more than anywhere else in the world. This is impacting consumers who are facing rising energy costs equivalent to large tax rises. And at the same time, we're seeing food inflation. This is putting huge pressure on disposable incomes. Central banks are prioritizing the fight against inflation over economic growth. Inflation really has been driven by a combination of strong economies, but also very restricted supply side. And what central banks are now trying to do is get that demand down to supply, even though I think actually the supply side and will improve quite significantly from here. But nonetheless, this is going to impact major economies. And the corporate news flow has deteriorated fairly rapidly since the first half. Industrial and consumer companies are releasing profit warnings. In Europe, in particular, has got potential gas shortages. This could lead to restrictions in use and limits on industrial output, again, worsening the macroeconomic outlook. And then liquidity is a real problem at the moment. You may have read the impact of pension funds having to unwind their liability hedging and being forced sellers of assets. And you are seeing significant peculiar moves in share prices, which are driving them away, share prices that is, away from fundamentals. Overall, it's not difficult to get to surmise that the current sentiment is extremely negative, and investors have abandoned Europe. So where could investors be wrong? Well, when consensus is all in one place, it's usually not going to continue in that way. And the consensus really is that Europe is the biggest underweight as a region for global investors ever, really. You know, is sentiment at the extreme? Can it go any further? Europe natural gas challenges, they're well known, but Europe has actually made good progress on refilling storage. bringing in new LNG imports. And in fact, economies have already reacted to and reduced consumption. So we think it's less likely that you're going to have limits on gas uses in industrial companies this year. The other thing says, unlike the global financial crisis, banks are well capitalized and do not present a material risk this time. Governments are also reacting quickly to the crisis that they're seeing ahead of them, while, on one hand, central banks are raising rates. On the other hand, the fiscal expansion has started, and the fiscal impulse from governments in Europe is much better than elsewhere. And indeed, the ECB, while we know they're going to raise rates, it's not going to be as aggressive as the Fed. The European economy is not running as hot as the Fed. The labour markets are not as tight as the Fed, so we don't quite have those problems. And then valuation, well, we'll talk about it in a few slides' time, but the valuation on Europe is excessively attractive at the moment. And then I guess the wild card, Ukraine appears to be making a bit better progress in the war. The expectations are that this will rumble on, but clearly any faster than expected conclusion to that will see an aggressive risk rally, and Europe will lead the way. But I think the point really is, what I'm trying to say is that sentiment is extremely negative, and history has shown that when big shifts in sentiment tend to provide great opportunities for stock pickers, and that's what we're starting to see. And the reality, there is always something to worry about in Europe. I think you could probably take any region, to be honest, but we've got a graph with the performance of Europe, and if we pick a couple of points here, if we go back to 2011, you've got the European sovereign debt crisis. We couldn't get in a room to speak to investors. No one was interested in Europe. The expectation was that Europe was going to break up. It didn't, and performance since then has been exceptional. And if you put capital to work, then you would have been richly rewarded. And again, the COVID crisis, the depths of that crisis, things were looking very grim. But that again was the time to invest. And indeed, as managers of European Assets Trust, we went out and bought a number of great businesses, leveraged the portfolio, and performance since then was very good until this year. So again, the historical context, it's easy to get carried away with negative sentiment, but negative sentiment can provide an opportunity. And again, we're put this chart in here to show the qualities of small caps. Over the long term, small cap companies tend to outperform. Why is that? Well, I think two main reasons really. They tend to grow quicker, and also they are beneficiaries of M&A, but also within the stock picking, I think you can get access to great managers who can drive businesses well with good capital allocation. And despite the recent fall, Europe small cap has outperformed most large cap indices, the S&P 500, world indices, Europe, and Asia Pac. And every time that gap has narrowed, has again been a attractive time to take advantage. So what about valuation? Well, this recent derating has seen Europe come back below historical averages. This was actually before this month, so we've seen markets fall about another 10%. This chart will look even more attractive now. But then if we look at Europe versus the rest of the world, or indeed we've got this chart here showing Europe versus the US, valuation on a relative basis has not been more attractive. It's cheaper than the financial crisis, cheaper than the sovereign debt crisis. History has shown that this has been a good time to invest. And again, if we look at small caps relative to large caps, you are now getting an opportunity to buy small caps at lower than their historic trading range versus large caps. So we think, while it's very difficult looking at sentiment, very difficult looking at daily red figures in the market, these are the times that you need to go out there, look for good businesses and invest. And I'm now going to hand over to Lucy to to discuss how we do that.
Thanks, Sam. So yeah, I thought we'd start off just with an explanation of our investment philosophy and process. So our investment philosophy is unapologetically simple. We believe that markets are volatile and inefficient and often driven by emotion over the short term. We also think then that this short-termism means that the market doesn't price great businesses well, as an assumption that profits will always get competed away. Whereas we believe with the really good businesses, that just doesn't happen. So we can use this volatility to buy really good businesses at good prices. We've done it in the past. We did it in the when COVID hit, and we were rewarded for that. And there's obviously, as Sam's alluded to, there's a lot going on in the market at the moment. But ultimately, we believe that this is another attractive opportunity to buy a very high quality company, which are now trading at attractive valuations if you can look past the short term. So I think it's best probably to give you an overview of exactly what we mean when we say quality companies and set up exactly the type of business that we like to own in the trust. For us, finding great businesses to invest in is about the combination of the three factors that we've got here on the slide. First and foremost, the company has to have a strong business model, which allows it to earn high returns on an enduring basis. We want there to be something differentiated about the products or services that it provides that mean that it's not only does it have attractive growth prospects and pricing power, but also the ability to generate high levels of profit and cash flow. We want to own businesses where this differentiation will ensure that it's very hard for a competitor to enter their market and take revenue and returns away from them. We don't see really the appeal of businesses that operate in a commoditized market where constant fight over price basically just results to a race to the bottom and erodes any potential that business has for the long term. Secondly, we want to ensure that these quality businesses have the right management teams behind them. Now, this is especially important in small caps where literally the day-to-day decisions that a management team makes can have an almost instantaneous impact on that business. We want a management team that's demonstrated the ability in the past to make good capital allocations that have further improved the quality of the company. And then we also want to make sure that they're incentivized on in the right measure to make the right capital allocations to generate long-term performance for the company as well. That's, I mean, one of the great benefits of being in the small cap space is that you can invest in family-run businesses where they also own a large number of the shares as well. So there's perfect alignment of interest in terms of making the right decisions for the long term. And then finally, we want to make sure that those shares are attractively valued. We believe in investing, what matters is the price you pay for an asset and then the cash flows that it delivered. Those last 2 points, quality businesses and strong management, I think take care of the second part, the cash flows that they're going to deliver. And then we think valuation discipline protects us in the initial part. So clearly, we think cash is very important. So we use discounted cash flow measures analysis alongside a number of other analysis factors to come up with a conservative assessment of the intrinsic value of a business. And then we invest when we have a margin of safety to that. And we believe that the combination of those three areas allow us to identify really attractive businesses which we can invest in for the long term in the trust. Now that leads to a portfolio of characteristics of the trust that look like this in aggregate. So we're a little bit more expensive than overall market in terms of, your PE and your EV to EBITDA ratios, but actually we think that is very reasonable, bearing in mind the other high quality metrics that are clear elsewhere in this list. So our holdings have much better returns than their peers, much better margins than their peers, and a lot less leverage, which is especially important at the moment, and historically have delivered much better growth. Now, again, we've alluded to a number of times, the current period has been challenging, but we very much believe these are the right characteristics for a company to have in order to deliver over the long term. Now, another way to look at our portfolio rather than just those characteristics is look into those moats and barriers to entry, which we've mentioned a couple of times already on this presentation, these are what will protect the operations of these businesses over the long-term period that we hold them. Now, those moats can comprise of a number of different factors, and this slide doesn't hold all of our holdings moats, and indeed some of these companies can fit into a number of these different boxes. So one element we think a moat can have is that if you're a disruptor or a first mover, or you have first mover advantage. So one of our long-term but very relevant examples of this still is CTS Eventim, which is an online ticketing provider. So obviously historically tickets were sold as physical paper that you had to go to a booth and buy, but CTS were one of the first companies to develop an online offering, which not only allows the promoters and the venues to increase their profits via selling them online, but it also provides them with a lot more data and information that they can also utilize to further increase their profits. So CTS have established themselves in here as a proven operator, and it'd be very, very difficult for anybody else to come in and disrupt their market leading position across Europe. Another example of what we think makes a great barrier to entry and protects the businesses in our portfolio is intellectual property. Now, it hasn't been a great performer so far this year, partly for reasons outside of its control, but a great example of this is our helmet inlay provider, MIPS. So they've developed a revolutionary and a patent-protected brain protection system that basically alters the rotational movement if you have a crash, and that helps to improve the injury outcome. So you find their products on the inside of snow, moto and cycle helmets, and then you'll also see there's a small yellow dot on the outside. So those helmet providers love a company such as MIPS because it increases the safety outcomes when using their helmets. They then can charge consumers a premium for buying that product, and because MIPS has established a brand and is known in this space, it's going to be very hard for anybody else to come up with an alternative product that helps prevent injuries to the improves the injury outcome to the same extent. We also believe that brands can offer a great barrier to entry as long as they are well established and obviously looked after by the management team. So a really great example of this is Lotus. So they own the Biscoff brand amongst a few others. The company was set out by the CEO's grandfather in the 1930s, and they're pretty much the sole provider of the speculoos biscuits across the entirety of the continent. They've got such scale that they have the best production costs of any branded cookie across the whole world, and obviously the brand is well established. So the combination of those two things mean that actually it's quite hard, say for example, a private label competitor to come in and take market share away from them. And then I think clearly one of the most obvious moats that a company can have is when the relationship or switching costs make it very hard for a competitor to take one of your customers away from you. So a great example of this is SIG Group. So they operate in basically a global duopoly with Tetra Pak as the two main aseptic packaging providers. So they have a razor blade model where they lease out their machines to the customers who then have to buy their consumables. So for example, it's the carton, for example, that you get your UHT milk in on a recurring basis. And the way that the machines work, the food safety guarantee is not valid if you don't use their consumables whilst working with it. So it's basically their customers have to buy their consumables for them, which of course leads to them to have ongoing recurring revenues and a much more secure business model. So hopefully that gives you a bit of a sense of the types of businesses that we want to hold in the trust, but both at a top level and then what kind of actual examples of what that means in reality for our holdings. And then the next question is really, are there any key themes or types of businesses that we're looking to invest in at the moment? I mean, has anything occurred or has anything changed in the last couple of years as a result of, first of all, we saw trade wars, then we saw COVID-19 and the lockdowns associated with that, and now obviously extreme geopolitical tensions. And is this highlighting any particular areas that we should look for, find those stocks that we like to look for at the moment? And so we've just the first line here is pretty much just business as usual for us. As mentioned, we'll always look for companies that have structural growth, hold pricing power, and that very much remains true. Of course, we have to be kind of cognizant at the moment. Has anything changed there? For example, if you operate in an energy intensive industry, are we still confident in their ability for that to continue to be the case and the pricing power to pass on the costs as and when they have increased, of course. of course, linked to that, we do think that the recent events have brought energy security and defence back to the forefront of national government's opinion, and that's unlikely to be changing anytime soon. Defence exposure is a pretty difficult one. It's a lumpy business. You have to deal with large customers. Normally, that's like a National Department of Defence, so their pricing power and control is limited. And of course, there are some challenges around that. And then in terminal value concerns is really addressing kind of around the energy companies. Of course, in the current environment, it's brought things to the forefront, and obviously you've seen countries go back to using coal, keeping and other measures rather than the push forward that we were seeing towards renewables. But in the long term, that's still going to come back as a challenge for those businesses. And of course, some of the businesses in that space are very much just commodity or plays on the commodity price, which, to be honest, as we've mentioned before, is the type of business we try to avoid. What there are in that space are some very high quality services companies. They meet our criteria for great quality companies, and we have added some of those to the portfolio. Another key change really as a result of recent events is regarding the end of globalization, clearly, and the need for reshoring, which alongside the rising costs is driving more and more demand for kind of automation and productivity providers to drive cost efficiencies at the businesses. So we've added an initial position in a warehouse automation system provider called Cardex, which plays into this theme. And then in the current environment, obviously, we think it's very key to be selective about your consumer discretionary exposure. We must admit, whilst we felt like we were being selective, we felt like we were owning companies that had pricing power, strong brands, and limited alternatives, as well as other tailwinds that should have helped them through this recent environment. Actually, our stocks in this space have hurt us so far this year, but we do continue to hold them. We think the long-term thesis is intact, but we're a bit wary about adding any more exposure to this space. And then, so Sam and I are just quickly going to run through a couple of the other businesses that we've recently added to the portfolio to give you a bit more information on them. So I'll just start here with Viscofan, which very much fits into that first line of a business as usual, a great quality business that has pricing power, it's got high margins, and it's got a good growth tailwind behind it. So they're a Spanish listed company that makes artificial sausage casings. So historically, whilst making sausages, the casing was made from animal guts. And obviously this has a number of issues. One, it's very hard to make a uniform product as a result of that. So it's hard for sausage providers to have a more efficient automated production line. It's pretty unpleasant work extracting and making the gut casing. And obviously you need to have an alternative solution for vegetarian and vegan based sausages. So what's been happening over a number of years is that there's been a shift away from natural casings to artificial casings. So that obviously clearly leads to more demand for Viscofan products. They are the market leader in this space, which gives them a number of advantages in terms of scale efficiencies, in terms of their own production. Their R&D spend allows them to create much higher quality products. And also their size means that customers are very willing to work with them as a partner. Once you pick your sausage skin, it's very hard again to change because they all have slightly different tastes, and it changes the taste of your product. And you obviously want to work with a company that has a strong balance sheet and you're confident will be able to meet your demand. Otherwise, you as a sausage producer can't sell your products. And in terms of what's changed recently for them, the COVID-19 pandemic and the resulting lockdowns have accelerated this shift. The problems in the logistic and transport space meant that actually it was very difficult to get for natural sausage skin producers still using natural casings to get hold of those casings, so it accelerated that shift for them. And because Viscofan sufficiently run, they were able to have the capacity to meet that demand, which means actually that their revenues have gone up, and we think that's something that is going to persist. And they also, of course, sell into a defensive industry, food. So if consumers continues to be challenged, that end market should be fairly stable. And with that, I will hand back over to Sam for the next couple of examples.
Thank you, Lucy. Okay, I'll quickly run through a couple more examples of recent purchases. Firstly, Bank of Ireland. We are quality growth managers So why do you buy a bank is often pitched to us. But actually, we think banks can be very good businesses. They can have sticky customer bases, and they can grow profits over long term. And indeed, one of our best contributors over the last 10 years is a Danish regional bank. We've decided to invest in the Bank of Ireland because the Irish economy, well, it's a reasonable place to be in a European context. The market has consolidated, so it's an oligopoly, and these guys are improving the returns on equity that they're making, yet the valuation is well below the book value. So what we think is going to happen is that this company is going to show the sort of economics that our Danish bank is has shown over a long-term time frame, and will therefore deliver good performance for us. Why now? Well, it's a combination of the consolidation market, but also we are now obviously seeing interest rates go up in Europe, and that provides a tailwind for these businesses, which has been, quite frankly, a real headwind for them over the last 10 years. And indeed, since we bought it, it has performed very well. The final example is a company called Siegfried, which is a CDMO, which is a contract development manufacturing organization, which makes small molecules for drugs or for pharmaceutical companies. Why is this interesting? Well, selling into the pharmaceutical space is attractive because these are uncyclical earnings, profit streams. But also the pharmaceutical companies themselves are outsourcing the production of small molecules to bigger providers, and the market's consolidated such that someone like Siegfried is winning share. The moat around a business like this is fantastic because you have to have regulatory approval for the plants, and someone like Siegfried will have the FDA or the European Health Authority constantly monitoring production, which makes it very difficult for new entrants to come in. Why now for this business? Well, they took over some Novartis assets a few years ago. They're now fully integrated, and we're starting to see the cash flow and profitability improve significantly. But also the balance sheet strength has improved, and this will allow them to do further M&A. So we think we've got upside from earning streams from the previous acquisition, but also we have the potential for value accretive acquisitions from here. Lucy sort of run through how we look at the portfolio. She's run through how we look at it in terms of moat, in terms of growth. We thought we'd put this slide in because some of these themes are not very popular at the moment. Technological innovation, well, that's had a really tough year. Health and well-being, as we've seen with the slide on sector performance this year, has had a tough time. Sustainability and emerging growth, these are areas that we think over the long term will deliver great performance, but over the short term have been very challenging areas to have exposure to. But we believe that these companies that have seen significant multiple compression are saving up some very strong performance for the future. So, we classify the portfolio in terms of the moats, the characteristics that provide the moats, but also in terms of the growth opportunities, and there's a numerous number of examples on this slide. So in summary, look, we're not going to shy away from the point that we've had some really challenging performance year to date, and that sort of overwhelmed our shorter term figures. But I'd like to reiterate that we have outperformed the benchmark in both NAV and share price terms since we've been managing the portfolio. This year, the challenge has really been because of our quality growth bias. And if you look at the peer group, it's the quality exposed portfolios that have struggled. Inflation and interest rates are a headwind for quality assets, but we believe while this is providing short-term headwinds, the strength of earnings power should prevail over the long term, and you're really not paying much of a premium for earnings power at the moment. Idea generation, as Lucy has said, is focused on existing long-term themes, but augmented by emerging priorities, automation, productivity, energy security. And we are looking to invest on the front foot. We haven't been geared in the portfolio up until now, but we will be looking to deploy gearing because we see opportunities, just as we did in COVID when we got to buy some great businesses at great prices, and that delivered very good performance for us in 2021 and 2020 and 2021. We will use this opportunity now to do the same. And we, as I say at the bottom, experience suggests that we should lean into this uncertainty. And with that, I'm going to hand back to Christine for some Q&A.
Great, thank you so much, both Sam and Lucy. So we've had quite a few questions, but keep them rolling in. So maybe to start off on something that you referenced there in the summary about performance, I think, Guy in particular has just asked, could you explain a bit more detail about the recent poor performance, especially versus the peer group? So yeah, he's made some good comments about the fact that the attributes of the companies that you're looking for should lead to strong performance. So perhaps commenting on why that hasn't then translated into the portfolio's performance.
Yeah, that's a good point. And as I say, we're not shying away from the difficult year we've had. We did outperform in 2020 and significantly in 2021. But this year has really been swamped by the exposure to growth and quality stocks. And actually, if you looked at our very narrow peer group with only 4 companies, if you look at the most exposed portfolio to quality growth, actually they've had a tougher time than us this year. So I think how do we answer this? Well, it's been a very challenging year, and that is swamping the sort of medium-term numbers. But I'd refer to the fact that we've outperformed in both share price and NAV terms since we've managed the portfolio. And that underperformance, as I said, has been due to valuation compression rather than operational performance of the stocks that we hold. So we do believe actually that in aggregate, 1 or 2 names, it's perhaps not the case, but in aggregate the portfolio is operating well, and we would expect again over the medium term for that to be rewarded. But clearly that has not been rewarded this year as the multiples have compressed as interest rates have gone up. Lucy, I don't know whether you want to add to anything there.
Yeah, I think it's obviously what's quite key is clearly for this year, as you've alluded to, this is kind of totally swamped. If you go back to that slide that Sam showed at the beginning, and you see that huge sector rotation that so far this year, if you look at the sectors at the top end of that range, they're not the type of companies that we think are the right ones to have in the trust long term. And yet the type of companies that we do say those ones more exposed to the healthcare space and slightly more defensive businesses have really been punished this year. But we think that actually as you come through this period, they will be the ones that will deliver you better long-term performance.
Great, thank you so much for addressing that. There's been quite a few questions about dividends. So firstly from Miguel, does the 6% annual distribution commitment constrain the exposure to stocks that do not pay dividends?
No, well, the dividend is paid out of both income and capital, and we don't go out and look for income generating companies. Yes, we want businesses that generate cash, but we actually, out of choice, we probably prefer them to reinvest that cash in their business to grow. But we're not reliant on finding income generating business to finance the dividend, because it is out of both income and capital.
Yeah. Perfect. And keeping on the theme of dividends, Elizabeth is asking, can you confirm the dividend at 6p per share will be maintained for the next 2 quarters? And are you able to estimate the dividend per share for the next financial year? Can you also confirm your level of dividend cover to meet future dividends? But I think you're alluding to it there, that it comes from capital.
Yeah, I mean, we do have significant reserves which do cover the dividend for a long time, but the 6% set at the year end NAV and the dividends for the next quarter are already announced and hedged actually back into sterling. So we have absolute certainty over the dividend the rest of the year. Next year will depend on what the NAV settles at the year end, and currently, we can't really say what that is.
Okay, yeah, that makes sense. Florian has asked, what were the 3 or 5 companies that contributed the most to the drop in NAV over the past year. What did you do? Sell them, add, or keep the positions unchanged?
That's a great question. If I look at, well, I mean, I think our worst performer year to date actually is one that Lucy has mentioned, and that is MIPS, the company that produces technology that goes into helmets that improves injury outcomes, and that's had a combination of sort of significant multiple compression, but also had a very peculiar issue with demand in cycling shops. While their biggest end market is cycling, and while there's a lot of demand still for their products, actually what you see in cycling shops at the moment is very low end stock, and cycling shops are not prepared to bring in new stock of high-end equipment until they sell the low end, which they ordered in COVID. So there's a bit of an inventory correction going on, which has seen a big hit to their sales in one quarter. But we in no way do we think that's going to impact the long-term investment case here. So actually, rather than reducing the shares, we'd be looking to add to it from here. And I think that would be the case for most of our underperformers year to date, where we think actually the operational performance of these businesses are well in the whole good, but we think actually are providing more attractive opportunities. For example, another stock there's been one of our main underperformance is a company called Flatex de Giro, which is now the European leading online broker. That's had multiple compression, but it's also had a hit to earnings because people are trading less. Quite obviously, when you're nervous, you trade less. But actually, that doesn't take away the long-term characteristics of this business, in that this is going to take market share from traditional providers of broking, because traditional providers in Europe tend to be banks, and they don't have the wherewithal or the technology offering to be able to provide low-cost offerings at attractive, with attractive front end, with attractive products. And so while I think that the theme in the portfolio this year, unfortunately, is that the structural trends are still the same, but they've hit shorter-term issues combined with multiple compression, certainly for the bigger underperformers. And in aggregate, we've tended to hold on to those companies.
Yeah, I can run through another one as well of our unfortunately poor performance this year, which is a company called Fludra, and they are the global market leader in terms of swimming pool equipment. And what's happened this year is obviously they've gone through a period of two great years in COVID, as people were locked in that home, and if you lived in a warm environment, you inquired about getting a pool installed if you had the space in your backyard in order to do that. So they've gone through 2 periods of great growth, and then obviously we're going through a bit more of a period of normalization here. That growth hasn't disappeared. In fact, if you want to get a pool installed, you still have to wait till next year in order to get it, and that's because there's a backlog booked in where people have already paid 30% deposits and are unlikely to shy away from having that done, even if the consumer environment changes a little bit. But what you're seeing is just a more normalization of growth. But again, what's great about this business is that actually 2/3 of its revenue are recurring. So once you've had the pool installed, obviously every so years, when something breaks, you need to replace it, when you need to get certain elements of it changed. So 2/3 of their business is the ongoing maintenance of those pools. So whilst you are seeing a normalization this year in terms of growth, and we did trim the position early on in the year, for that, actually what's happened during COVID has improved the long-term position for this business, because there are now more pools installed which will need more ongoing recurring revenue.
And actually, I think Miguel's question about earnings estimates ties into that last one. So he's asked, how do your earnings estimates for the companies in your portfolio compare to consensus estimates?
As in, I think the question is well, sorry, I'm not sure whether that's historic or forward-looking. We would expect the earnings to outperform the market because we think these companies are better and faster-growing businesses than the market. And if we look historically, when Lucy showed the characteristics, they have also outperformed the market. This year, I think maybe that's the question referring to this year in a challenging environment. I think in aggregate, actually, I think yes, clearly we've had some consumer exposure, discretionary exposure where we've seen downgrades, but I think in aggregate the portfolio has operationally performed pretty well, and I think it's difficult to say, but I think it's probably outperformed the market, though the multiple compression has overwhelmed that.
Mm-hmm. Okay. Then Michael is asking, what constraints do you have being invested in small cap? What's your minimum market cap for the investment universe?
We invest below the largest stock in our universe, which is roughly about 6.5 billion euros at the moment. There's plenty of companies to look at. There's over 2,000. And once we invest below that, we don't have to sell. So, we hold ASMI, for example, which is a very, very large company now. But the aggregate exposure to the portfolio is well below that. Sorry, the average exposure to the portfolio is well below that 6.5 billion.
Yeah,
and in terms of the minimum, if you wanted to kind of cover that, there's no actual minimum, but obviously what we need to bear into account is obviously the position size that we'd be as a holder of that company, and also the liquidity of that company, and that's something you have to be very wary of as a small cap investor. So we have to be confident about the liquidity of that company, and in fact we actually incorporate that into our assessment of a fair value of a company. So if a company is a bit less liquid than the general market, we have a higher hurdle rate in investing into it.
Okay, perfect. So maybe just the last question, and it's a bit more detailed, is again from Miguel. When you were talking about the defence stocks, Lucy, he says he understands the ESG challenge, but maybe just comment a little bit further on that terminal value concern.
Oh, right. Oh, the terminal value concern was more kind of around the energy companies that that maybe we should change that bullet point slightly, but it was kind of saying that we think what's happened so far this year in Europe has led to obviously a change in the focus for energy companies and defence companies. Defence companies, we think, have the ESG challenges mentioned, and then on the energy side, whilst, as I said, you've seen this go back to using fossil fuel-based energy at the moment, we think actually the long-term challenges are still there for those industries, and the push towards trying to come up with a better alternative for energy supply, it hasn't gone away, even if it's maybe been temporarily paused for a couple of years.
Great. Thanks so much, and we'll finish off there.
Yes, thank you very much for that, Sam, Lucy. I think you've addressed those questions you can from investors, and of course the company will review all questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which is particularly important to the company, Sam, could I just ask you for a few closing comments?
Yeah, well, thanks everyone for joining today. Clearly it's tough times in the market, and performance is not where we would like it to be, but we would like to sort of take a long-term perspective on this and use the volatility to invest in great businesses at good prices, and that should yield good long-term returns and help us outperform the benchmark in NAV and share price returns, like we have done since we have invested, since we've managed European Assets Trust.
Sam, Lucy, thanks once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of European Assets Trust PLC, we'd like to thank you for attending today's presentation, and good morning to you all.